Welcome to the Rob Seco Field Ready Podcast with your host, Jim Robinson.
Hello, and welcome back to the Rob Seco Field Ready Podcast. I'm your host, Jim Robinson. The USDA is going to be releasing their final production report here in January, and so what we wanted to do is bring back Bob Linneman with Kluis Commodities to talk a little bit about the report. Welcome back, Bob.
Hi, Jim. How you doing, sir?
Doing very well.
Good to be back.
Thank you so much for joining us again on such short notice.
Yeah, no problem.
Hey, so can you tell us a little bit about this final production report that the USDA is going to be releasing on January 12th?
Yeah, there's throughout the year, there are three big reports as far as in the grain markets. Usually every year you kind of count on three of them. This is one of them, the January final production report, the March planting intentions report, and then the June planted acreage report are the three big ones, as we say, throughout the year. So this one, historically, fireworks are usually blasting within seconds of this report coming out, whether it's up or down, Jim. So it's in the last few years, honestly, it's probably been the most calm and reserve as far as reaction in the markets, just because we really haven't had, much of a change expecting going into this report. Now this year is going to be different.
What are they reporting in this report first before we get in where this year comes in?
Yeah, so in this report, they are going to update us on final acreage for both corn and soybeans. They're going to update us on not only planted acreage, but harvested acres. Then they will update us with final yield, which will then translate to final production. And then we should see, as we just work down the balance sheet, we should see adjustments to usage as well as, so once they adjust the production, then they'll adjust the usage, and which will take us to the bottom line, that stocks to use ratio and or the carryout for the year. So those are in that number. And then you switch over and you look at the WASDE information, which is released at the same time for the world supply and demand. A lot of guys are expecting, a lot of traders are expecting to see South America's numbers decline again. We saw that in December, which is normally a quiet report, and it was a small adjustment, granted. But the trend, we've talked about this before, Jim, that traders want to see the trend and they follow the trend. And right now, the trend is for a declining production in South America. So it just kind of is, as of right now, things are leaning to the bullish camp.
Absolutely. I mean, a decreased production in South America. And if there is a decrease in production in this crop report coming out, what could that possibly do to the markets?
That's a great question. I mean, you can see in the last, pull up any daily chart on any website, and you can kind of see what the market has done based on all of these expectations of a declining South American crop, of a tightening supplies in the United States. Russia came out with their adjustments to exports for their wheat crop, and that kind of gave life to the wheat market in the U.S. here on the Kansas City and Chicago board side of things. So it's just been every news story that has come out, it seems like is aiding the bulls. Now, I would say that the bulls were due those news stories. It's been a long time since we've been able to have that much bullish information hit the market kind of on a consistent basis. So we went through, a few years, it felt like, where we couldn't scratch and get anything for a bullish story. And now it seems like the overwhelming amount of headlines are favoring those bulls. But, as to answer your question, what could happen in the markets? It'd have to be a pretty big cut in production on the overall total to South America, Jim, to really see those numbers impact prices. I think most everyone is expecting another smaller trim in total production, but they still are going to produce a big crop. There's no second guessing that. The number of acres that they continue to increase every year, they're going to continue to produce bigger and bigger crops just by the nature of it without a major disaster. So everyone, I think, is focusing on more what happens in the United States. Where do we end up with the United States? And really the supply and demand, how do you adjust production and then adjust usage? And look at the bottom line of those balance sheets, Jim. It's going to come down to, especially in soybeans, where is our carryout? Do we maintain a triple digit carryout? Are we going to be over or under 100 million bushel carryout? And that is a huge question right now. And I think overwhelmingly traders are more interested in that than what they are in any possibility of what a bullish corn number could look like. It just, you've seen soybeans rally here recently, and here we're record this, but the bounce has been, 50, 60 cents, and you see corn move a nickel, those types of things, Jim. It's hard to see corn just be so slow when beans are moving so quickly. So that's a tough one to look at, but.
Absolutely. Yeah. The soybean market's moving a lot more than the corn market. And a lot of that's driven by, as we talked before, increased demand over what initial expectations were, or at least what they were, early on in the summer or last spring. So with this report coming out, what do you expect to show for the U.S.? Do you think it's going to be an increase in carryout, a decrease in carryout? Do you have any hints on what that might be?
Yeah, it's a great question. Honestly, the trade is looking for production to probably decline a little bit based on surveys. We've seen a lot of private analytical firms kick out their customer-based surveys, and I think the trade is expecting some type of decline there. So when we factor that into the idea of, especially in soybeans, where the USDA hasn't really adjusted exports. And we talked briefly last time about how the export game and the big demand for soybeans is what's kind of driving this price hike and this price rally. And now if we come in and we see the USDA trim back production a little bit more and make some type of bullish adjustment to exports, which traders are expecting, and they're kind of ramped up prices into that does question, the idea of, can we maintain 100 million bushel carryout, Jim? And can stocks to use ratio stay above 3%? And there's a lot of question marks out there, Jim, that a lot of traders are expecting this thing to get really tight. And, similar years, like we talked last time as well, 2013, 14 and 14, 15, in those years, 13, 14 for sure, we had to import soybeans. We literally, the U.S. had to import soybeans that year. And a lot of folks are expecting that this may be another year that we have to import soybeans to get us through the summer. So if that unfolds, Jim, the fireworks, like I said before, it could get interesting.
Absolutely. So there could be an awful lot of movements one way or another, because a lot of people have already, have estimates on what could happen, likely a decrease in production in soybeans, potentially less than 100 million bushels in carryout in soybeans. So what should a farmer do in order to best protect his current position, but at the same time not give up anything going forward for any grain he may have stored?
Yeah, that's a great question. And I think a lot of folks are probably feeling pretty good about their decision to put whatever they could in the bin, and that has paid off. You're not really making much in the carry in the market, but when the market rallies like it has, you're not really concerned about the carry. You're not, that's our normal way of making those bins pay for themselves. This year, not so concerned about that. The price hike has helped that. So what can you do, even for soybeans and corn, whatever you have that is unpriced? Even though we may be bullish going into this, Jim, at these levels, you really should have some type of price protection in place ahead of that report. There are ways. Either give us a call, Kluis Commodities here. I'll give you my number at the end. Get in touch with your broker. There are more inexpensive ways, short-term ways to buy puts that you don't have to go out to July. You don't have to go out to November and pay a lot in time value. You can buy something that's going to get you through the report and give you a few days or maybe a few weeks after that report comes out and protect from price going lower. Even though you might be bullish, even though everyone is looking for that bullish report, having something in place as a safety net, Jim, at these levels it's the right thing to do. And you just look at it as an insurance policy saying, man, I hope I buy this thing and I don't have to use it. And really that is the safest route to play this. We've seen this time and time again where everyone's bullish or bearish going into a report. The report comes out, it is a bullish or bearish report, and the market goes the opposite way by the end of the day. And everyone's left scratching your head going, what's going on? And then you think to yourself, oh, it'll come back tomorrow. It doesn't come back the next day. And then the next day it still doesn't come back. So don't get caught in that when there are opportunities, especially at these levels. You can afford to pay that dime or 15 cents or whatever it ends up costing to protect what you have that's unsold, what's in the bins, especially at these levels, Jim.
Exactly. And as we record this episode shortly before Christmas, a lot of these prices are really profitable prices on a per bushel basis. And so protecting that profitability is really, really important.
I agree. Yep. 100%.
Yeah. So if it may cost 15 cents a bushel to protect your floor, but how might one take advantage of the upside then going forward? Let's say the report does come back and we see a major swing upwards in prices.
Yeah, another great question. Let's say that you have already sold most of your grain, or you're selling into this rally ahead of the report, which is a great idea. Marketing wise, it's profitable, like you said, Jim. There are ways to be long the market, to buy calls, do things that you can retain ownership of those bushels you've sold, for ways that you can still sleep at night. Buying those call options, knowing what your premium cost and what your risk is, and then you can just sit on it. Now, granted, at these levels, these options are more expensive. If you start reaching out there, I was looking at a few things for customers today, and we quoted some July at the money calls that were 80 cents, which is, you might look at that and say, oh my gosh, I'm not spending that. Well, and I don't want to dissuade anyone from being in the market and partaking, but at the same point, you have to manage that position. Whatever position you put in place when you are using puts or calls or any type of marketing strategy, you have to manage it. And if you get in and you buy that 80-cent option and you're wrong and the market goes below a certain line in the sand that you draw, if it falls below that price, you just get out. And you conserve that capital and you manage your risk that way. You don't just put it on and walk away from it, Jim. Those are things that I try really hard to work with my customers on and have those conversations before you even place a trade. What are your goals with this trade? What are you wanting to do? And if you're right, when do you want to get out? Kind of walk through that scenarios, both up and down, Jim. It's the best way to attack that situation.
Yeah. I mean, there are so many different positions that farmers are in today. Either, they've already sold most of their grain on the market, or they have some unsold grain in the bin. For those guys in general that are looking to, make sure that they have a profitable year, but potentially, capture a little bit more than that, they can definitely participate in the market this way. But at the same time, they have to know their price. I mean, how soon should people be looking into making these moves prior to the report coming out?
Yeah, those are always hard questions to answer, Jim. The timing of these reports, you can study these January reports, any of the monthly reports going back 30 years, and you might think you have found something as far as a tendency or a seasonality, and then that next report, you're dead wrong. So it's tough to do that. I would say look at your bottom line, look at the current prices where they are, your production, look at, like you said, look at the profitability of your farm, and then decide, do you need to be a part of it? Do you want to be a part of it? How much do you want to commit? And from there, I wouldn't wait too long, to be honest. I think if you're first couple of days of January here and still sitting in that boat, I would probably move a little bit quicker, and I wouldn't want to wait till the day up. You might miss a little bit on the top. You might get real close to the top and the market fall down. That's all fine. You're taking part in a bigger move is what you're looking at. You're not trying to nail the top within a nickel. You're just trying to play in the game as far as when it really starts to make its next leg higher. That's what you're after.
Exactly. Now, to shift a little bit, as we're looking at, we've been talking about, unsold grain or grain that's currently in the bin, but looking into 2021's crop, how are you advising a lot of your customers right now on what they're considering? I mean, you said it yourself that there are bigger price swings in soybeans right now than there is in corn. So what's your discussion with your customers going like?
Yeah, so actually having a lot of those conversations, Jim. So this is a good point. On Monday or Tuesday, I had a handful of guys sell some cash beans off the combine for $10 to their local elevator, just a semi-load or two, just a couple thousand bushels, but that's where we're starting, and that's a great place to start. Absolutely nothing wrong with that. We turned around and we bought some mini contracts in the July futures to try to retain ownership of those bushels a little bit, just because we think that there is still more upside to this. But at $10 cash beans, that's profitable. That works well. When you look at the acreage battle that we talked about last time, Jim, I think that still is out there. I think that's a real possibility this spring. The corn to bean ratio right now, just before this meeting started, I think I calculated at 2.59. That heavily favors soybeans.
Oh yeah.
For new crop. I mean, big time. So corn is going to have to buy some acres somehow, and you've got December corn trading right underneath 420 here today, with November beans knocking on the door at 1090. And if this bean market continues to move, corn again it's gonna follow along. When that corn really comes to life and gets exciting, that's, I think, is when the battle for the acres is going to have to ensue, because we're at a 2.9 or a 2.59 ratio. If it goes to 2.69, 2.75, I mean, if that continues to rise, it just is going to make it harder for the corn guys to sit back and say, wow, I should plant a lot of corn at those levels. It doesn't make sense, so something has to change there. And I do think corn has some potential, but it just is going to be a little bit slower, like we talked at the beginning, a little bit slower than the soybeans will.
Exactly. I mean, it's a dynamic system between corn and beans and how those acres work. I mean, we could see local basis playing a really big role in dictating what local acres look like.
100% agree with that. Yep. And still watching those spreads, the July versus November soybean spread. I think last we talked, I think we were right around $1.10, somewhere $1.15, maybe $1.20. I think today it traded $1.57 on that spread. So it's going to continue to rally. I think should be a fair amount of optimism in that as it continues to go forward. And I'm going to use that and recommend others use that as kind of a barometer to watch. If that starts rolling over and falling apart, then the game could be over. This rally could be over for a little while. So just continue to watch that spread.
Yeah. So I think if I could kind of summarize everything right now, with the January 12th report from the USDA coming out, as well as the WASDE report, we could see a slight reduction in overall production. It may not necessarily go that way, but that's where the trend seems to be pointing. And so what that could ultimately do is cause some pretty good movements in the market overall, especially for beans, as beans tend to be moving a lot more than corn is at the moment. So what farmers can do at the moment is look at any bushels they have in the bin, and potentially, if those bushels are unsold, put a put on them so that they can protect their bottom, and then look for any opportunities they have to cover that spread and capture some of the upside that may be coming. At the same time, if things have already been sold or marketed already, there are opportunities it may be a little bit expensive, but to capture some of the upside and some additional profitability. What the farmer really needs to do is look at their own individual profitability, decide if they want to participate in this market swing or not, but then also be looking into their 2021 crop and getting an understanding of how much should they market today right off the combine, how much should they hold in the bin for a longer period, and ultimately decide what acres make the most sense given the current corn to soybean ratio.
That sounds like a great summary, Rob. That was a great summary.
Perfect. Well, hey, Bob, thank you so much for coming and joining us again on the episode.
Yeah, Jim, I appreciate the opportunity. Thank you, sir.
Thank you. So, as always, be sure to tune in on the 1st and 15th of every month for new episodes. And until then, stay field ready.
Thanks for tuning in to this episode of the Rob Seco Field Ready Podcast. Join us next time to be field ready.